Hey everyone, the second quarter GDP number just came out, and it was a bit below expectations, but still quite high. GDP grew by 6.5% in the second quarter. Aside from the giant 33.4% bounce in the third quarter last year, following the steep second quarter drop at the onset of the pandemic, it's the strongest quarter since 2003. In conjunction with the 6.3% growth in the first quarter, it looks like 2021 will deliver annual economic growth in the high 5% to mid 6% range. Now that's a bit below what economists have been forecasting, but it would still be the strongest year of growth since 1984. Strong GDP growth reflects gains in sectors across the broader economy. Things like consumption, international trade, housing, business investment, and government spending. Digging below the surface, I want to highlight some key benchmarks. In the first half of this year, core retail sales have risen 15.6%. That's huge. That's more than triple the next best first half ever recorded. About 3.3 million jobs were created. That's the most jobs ever added in a first half of the year. Average hourly wages are up 1.6% since the beginning of the year. Consumer confidence is back to pre-pandemic levels. Home sales are up by 7.8% compared to mid-year 2019 before the pandemic, and air travel is back within 10% of pre-pandemic levels. All of these are really robust results and point to rising commercial real estate demand across all sectors. Effectively, the rising tide is lifting all boats. We're already seeing strengthening demand for housing, industrial space, retail space, seniors housing, hotel rooms, and self-storage. Office space demand is still lagging, but it moved into positive territory in the second quarter, the first positive absorption since fourth quarter of 2019. And investors are underwriting based on strong growth through the remainder of this year and into 2022. Many of the investors that went to the sidelines through the pandemic have finally begun to return. This release of pent-up investor demand has bolstered market liquidity, supporting a revival of transaction activity, basically bringing second quarter commercial real estate sales back into alignment with the second quarter of 2019. Investor demand is being supported by particularly low interest rates, with the 10-year Treasury back down to the mid 1.2% range. Debt availability for most asset types and locations is increasingly available, even for hotels. Just a few months ago, hospitality sector assets had a really difficult time getting financing. But aside from a few notable exceptions, the market is starting to open up again. Looking forward, the wild card on the interest rate front is, of course, the Federal Reserve and how they respond to inflationary pressure. In a statement last week, the Fed appeared to be sticking to their guns, suggesting that they won't taper their Treasury purchases in 2021. That could change, of course. But for the short term, it doesn't look like interest rates will push up soon, at least not substantively. The convergence of these trends suggests that the commercial real estate market will be quite vibrant this year, unless, there's always a caveat, unless the Delta variant of COVID forces another economic shutdown or significant behavior changes, or if Congress moves forward with significant tax code changes with drastic increases of capital gains taxes and or dramatic cuts to the 1031 exchange program. Now, I need to point out that we have no new insights on prospective tax law changes. There's no news on that front since last April. But the scale back of the infrastructure proposal going through Congress from $3.5 trillion to about $1 trillion should ease some of the pressure to raise taxes. So, although some headwinds could emerge in the second half, things are looking pretty good for commercial real estate investors right now. But as always, we need to keep our eyes on the horizon.